Are you ready to save big on your mortgage, loan, or credit card payments? What if I told you that the recent interest rate cuts across Europe could change your financial future forever? Stay tuned to find out how these rate cuts can put money back in your pocket and what you need to know to make the most of this golden opportunity. Welcome back to Economic Insider, where we bring you the latest updates in finance to help you make informed decisions. Today, we're diving into a topic that's impacting millions across Europe: the recent interest rate cuts and how they're affecting mortgages, loans, and your financial future. It's a crucial discussion for anyone navigating the financial landscape in 2025. Let's break down what these rate cuts really mean for you and your wallet, because understanding the full picture is more important than ever. Over the past few months, central banks around Europe, including the European Central Bank, ECB, have announced interest rate cuts to support economies facing inflationary pressures and slower growth. You've likely heard of these cuts, but how do they actually work? And more importantly, how will they impact you? While this might seem like good news for borrowers, the effects can vary depending on the type of loan or mortgage you have. For homeowners, prospective buyers, and those with personal loans, these changes could be a game changer. So, whether you're planning to buy a house, refinancing your loan, or looking at new borrowing opportunities, it's essential to understand how these changes will affect you. Let's dive in and break down exactly what's going on here. Before we dive into specifics, let's first understand the basics. An interest rate is essentially the cost of borrowing money. Think of it as a fee that the lender charges for providing you with the capital. When you take out a loan or mortgage, the interest rate determines how much you'll pay in addition to the amount you borrow. But what does it mean when the central bank cuts rates? When the central bank cuts rates, it becomes cheaper for banks to borrow money. This lower cost is then passed on to consumers. For mortgages, this typically results in lower monthly payments. In practical terms, that could mean saving thousands of euros over the life of your loan. Let's say you have a €300,000 mortgage with a 3% interest rate. Your monthly payment could be around €1,265. But with a recent rate cut, if your rate drops to 2.5%, your payment might drop to €1,200. That's a €65 savings each month, and over a year, you could save around €780. Over the 20 to 30-year life of your mortgage, those savings can really add up. That's just one example of how these rate cuts could benefit you. But it's not all sunshine and rainbows. There are some factors to keep in mind as we move forward. For homebuyers in Europe, these rate cuts are both an opportunity and a challenge. On one hand, it makes borrowing cheaper. If you're thinking of buying your first home or upgrading your property, now could be the perfect time to secure a lower rate mortgage. Countries like Germany, France, and Spain are seeing a surge in interest from prospective buyers. But let's not get too excited. While lower rates mean lower monthly payments, many markets are also experiencing rising property prices. This has become a significant issue in places like Paris, Berlin, or Barcelona, where housing demand is outpacing supply. So, while you may secure a cheaper mortgage, the overall cost of purchasing a home may still be high. In some European cities, property prices have seen steady increases, and these rising prices could offset the benefits of lower rates. For instance, in London and Paris, demand is still incredibly high, which means you could secure a mortgage at a lower rate, but might still face steep prices for the property itself. Many real estate experts are cautioning that potential buyers should factor in the rising costs of homes, especially in urban centers where demand is high. Even though interest rates are lower, the overall price of real estate continues to climb. The key takeaway here is that yes, you can save money on your mortgage payment, but make sure you're also keeping an eye on property prices. Refinancing your mortgage is another way to take advantage of these rate cuts. If you're already paying off a mortgage or loan, refinancing at a lower rate could help you save money over the long run. But how does refinancing work, and when is the best time to do it? When you refinance, you're essentially replacing your existing mortgage with a new one, ideally at a lower interest rate. Imagine reducing your current mortgage rate from 3.5% to 2.2%. This would not only reduce your monthly payments, but also save you thousands of euros in interest over the life of your loan. For example, let's say you have a €200,000 mortgage with 25 years remaining. At 3.5%, your monthly payment might be €1,000. But if you refinance at 2.2%, your payment could drop to €900. That's a €100 savings every month, or €1,200 annually. And over the next 25 years, the savings would be substantial. It's not just about saving on monthly payments. Refinancing could also shorten your loan term, which means you'd pay less in interest overall. But before you rush to refinance, it's essential to consider all the factors. You'll need to check if there are any fees or penalties associated with refinancing. Some lenders charge penalties for early repayment or for breaking your existing contract. Make sure you run the numbers and work with a financial advisor to ensure refinancing is the right choice for you. Interest rate cuts don't just affect mortgages. They impact personal loans, auto loans, and even credit cards. If you're planning to take out a loan for a major purchase, like a new car or a home renovation project, this could be a good time to lock in a lower rate. For example, if you're taking out a €10,000 personal loan, a rate cut of 1% could lower your monthly payment by €20 or more. It might not sound like much, but over the course of a year, that's a savings of €240. If you're considering buying a new car, lower interest rates could also have an impact. A lower rate on your auto loan might mean the difference between a €300 and a €280 monthly payment. Over the life of a loan, that can add up to a significant amount. Now let's talk about credit cards. If you have an outstanding balance on your credit card and the interest rate decreases, you could see your payments go further toward paying down the principal rather than just the interest. This can be a great opportunity to reduce your debt faster. It's important to note that these benefits can vary depending on the type of loan you're applying for. For example, personal loans often have fixed rates, which means if you get a lower rate now, it will stay with you throughout the life of the loan. On the other hand, auto loans and credit cards can have variable rates, which means your rate could increase in the future. While lower rates are great for borrowers in the short term, it's crucial to consider the long-term risks. Central banks generally cut interest rates as a response to economic challenges like inflation, slow growth, or other financial pressures. But what happens if the economy doesn't recover as expected? Central banks use interest rates as a tool to manage inflation and stabilize the economy. If the economy recovers quickly, central banks may start to raise rates again to prevent inflation from spiraling out of control. If rates go up in the future, it could impact your mortgage payments, personal loans, or credit card balances. That's why it's so important to think about the long-term picture when making financial decisions. One thing you can do to protect yourself is consider locking in a low rate while you can. Many lenders offer fixed-rate mortgages, meaning your interest rate won't change for the life of the loan. This can be a great way to secure predictable payments, even if rates rise in the future. So, to wrap up, the recent interest rate cuts in Europe bring plenty of opportunities for savings on mortgages, loans, and credit cards. However, there are also risks, especially if rates increase again in the future. Be sure to carefully assess your financial situation, evaluate your long-term goals, and consult a financial expert to make the best decisions for your future. Don't forget to subscribe for more updates on personal finance, mortgage tips, and how economic trends impact your financial life. Let us know in the comments how the recent rate cuts have affected you, and if you have any questions, we're here to help.